I want to welcome Kirian von Hest, also known as Deso. He does brilliant research, which investors all over the internet are flocking to because it's unique, it's actionable, and he has a successful track record. And we're lucky enough to hear some of it now. So welcome, Deso.
Hello. Welcome to be back.
Yeah, no, thanks for coming back. So my first question is, should I put my entire life savings in GameStop?
Well, I think it's a little bit too late for that.
Right.
You could have done it if you were watching the Wall Street Bets Forum back in January. I wasn't. Otherwise, I might have even done that. But yeah, that's you're either diamond handing or you missed the boat.
Yeah, or you're absolutely crazy. So not a real question. The real big important question I have has to do with, to me, the biggest story in finance, which is the crashing U.S. bond market. I've been waiting for this for years because, I've always known that in order to have that 1970s style inflation scare, you have to have that 1970s style bond crash. And it just started, we just had the FOMC meeting. Today is 3/17. We just had it today. Bonds sank even further. So could you give us your take on where this is all headed?
Total disaster. Well, we're not even heading towards total disaster. We're already at total disaster. The meeting in itself, I didn't even watch it because I was just interested in the end result. Because even before the meeting started, the outcome was clear. It was the immovable object of the bond market versus the unstoppable force of inflation, and something had to give. Well, the way the meeting went down, as I heard it, QE didn't get expanded, no yield curve control, no dot plot increase, and they did nothing. And the bond market didn't very much like that. So it went all over the place, as the market does. We are getting the read on what the market thinks. Well, as we're recording this, it's on my time, 7:30 in the morning on Thursday the 18th. And currently, bond yields are up. 10-year yields already spiked to 1.683. And that is considerable. Dollar index is flat. So it's one or the other. Either the dollar goes down and bond yields stay flat, or bond yields go up and this dollar stays flat. And there's just no other option left.
Yeah, agreed. And so if they were to just let the bond market crash, obviously that would just decimate risk assets. It would decimate a lot of different areas, right? Mortgage rates would spike.
Oh God, what wouldn't get decimated? It goes far beyond that. Immediately, the national debt of the U.S. becomes unsustainable, and the U.S. go bankrupt. It goes for just about every Western nation as well. All of the houses are going to be unaffordable, which means everyone has to sell, which means there's just a giant amount of supply with no demand, which means prices go through the floor and through the cave below it as well. What doesn't crash? I think you could you're faster done just saying what doesn't crash.
Yep. And the thing is, so we know that's just, to the US government, that's just not an option. So their option is to suppress those bond rates, which are naturally crashing, just suppress them artificially. So then what ramifications does that have?
Oh, again, there's a dead dollar. There is only two options left. Either the bond market goes or the dollar dies. And we all know what is going to happen. The dollar's going to die because there's just no way in hell they can let the bond market go. It's just that Jerome Powell hasn't realized it yet, that that is the only two options he has left because of his inability to act. If he wanted to implement yield curve control, he should have done it already. But if he does it now, the dollar dies because people just don't believe him anymore. This is now this was a solvency crisis that started with the repo crisis in 2019. And because they added more and more and more debt to a system which had a solvency crisis, which means there's too much debt, at some point something's got to give, and that basically changed around November last year, where hyperinflation more or less really took off, and they still don't want to do anything. So now, who still believes this clown? That's the point. No one believes Jerome Powell anymore, and no one believes he's going to do anything before it's too late. They say the Federal Reserve says that they can control inflation when it comes. But the problem with Jerome Powell is that he hasn't made a single decision in his entire career that was preemptive. I'll give him credit. He is really fast, because when the repo market crashed, he had no problem starting up QE immediately. So he is fast, but he is also 100% reactive, which means that when inflation gets too much, they will act. But by very definition, when inflation becomes too much, it has become too much. So acting no longer matters. And that is the situation where we're now headed towards rapidly.
And it's like they're waiting for the fire to get bigger before putting water on it, and instead of doing it earlier, like you're saying they should do.
Yeah, well, at this point, it's only guessing what their real motives are to letting all of this go on this far. But I am willing to just put my money on incompetence. This goes beyond criminal behavior. This, if they were purposefully negligent, there would be some way for them to gain something out of all of this. But they are purposefully destroying themselves. When the bond market goes, the Federal Reserve goes. We might see a bankruptcy of a central bank in our lifetime. That might not even be that far away. I don't even know it's possible, but we're going to find out. So the Federal Reserve does not stand to benefit from Jerome Powell's behavior in any single form or way or manner. We know that the dollar has to hyperinflate because the debts are too big. They will never be paid back. So the only recourse is to devalue the currency. But they're not even doing that. They didn't increase QE. What I would have figured is, now that stimulus is passed, we know that the US government is going to issue a lot more bonds. Someone has to buy them. We had a 7-year auction failure last week or 2 weeks ago, whatever that was. Time goes so fast now. They have to do something. Someone has to soak all the bonds, and the Fed said they were the buyer of last resort because they've been QE infinitying it up since September of 2019. And now they're saying, no, you guys deal with it. That's not going to end well. So it's gross incompetence. If they were sticking to their plan of trying to devalue the currency, they would have upped QE, and they haven't done that.
Yeah, absolutely. So let's fast forward to the announcement when they do announce yield curve control. And to me, it seems like something similar to today will happen, where the dollar will crash, stocks will spike up, gold stocks will spike up. But what kind of world do you see will come to fruition if that announcement happens? Like, do you think stocks will continue going up?
Yes.
What do you think will happen?
Oh, it's very easy. Stocks will continue to go up across the entire range. Even assets that make no sense will go up. SPACs will go up. You'll see much more of those. Because when the Fed announces yield curve control, it's officially the start of the dollar dying. That is where we're at now. The moment they announce yield curve control, that is the moment where we get certainty in the markets. Because as I said, currently it's a question. Does the dollar die or does the bond market crack? Because Jerome hasn't done anything today. The question's still left open. It's not a good question. I'm not saying it's a good question, but it's a question that's going to need answering. And it's still not answered. Yield curve control will be an answer. Basically, that the yields will not be allowed to rise. That is the answer. But that leaves only one option, and that is that the dollars have to go down, and will continue to go down, and it's not going to stop going down.
Yeah, so that is a really big, important question. Kind of, what will the magnitude of the loss in confidence be? Because could it be just another one of these, oh, great, assets go up, rich people get richer, poor people get poorer, and inflation doesn't trickle down yet?
Yes, just pure yes. I know it doesn't make sense to answer just yes to everything, but it's all going to happen. you're going to see everything happen, but only in stages. So initially, and that's going to happen very soon, it's going to happen this summer, there's going to be a great bonanza of buying. You're going to see spending and GDP increases like you've never seen before, because everyone will be flush with cash and everyone will be spending it. Now, the first supply cycle, when you buy a good, prices don't immediately go up. There's a stock. Goods are in stock. The goods go out of stock when, enough people buy them. Now that everyone's flush with cash, that still has purchasing power, and that is the key point that everyone always seems to forget, the purchasing power of the cash. Once they spend it the first time, it still has the purchasing power because the goods it buys were produced under the previous currency spending power. Like, there are cycles to currency's purchasing power, and under the previous cycle, goods were produced at a price. So as long as the goods are in stock for that price, inflation doesn't do anything. Now, let's say the goods are bought, go out of stock, they are ordered more. Now, the supplier or the factory also has a supply of goods. Not that much, because we live in a just-in-time system, but there's always a little bit of a buffer. And that buffer was produced at a price, and it'll be sold at a price. So inflation doesn't do much. But when that producer runs out of his goods, he will need to order more raw resources to produce more. Now, that's already going to show an uptick in inflation because there's more demand for his goods than was previously. He can only produce so much, even with unlimited raw resources. And if the demand exceeds that supply, as it did because it ran out, the next batch is just going to auction off for more. Like, the highest bidder wins. It's just when stocks are depleted, everything goes to an auction process. Now, when the raw resources run out, that is when you're going to see a real hyperinflation, because the person who mines the raw resource out of the ground cannot possibly scale up production. It's not doable, because if the metal's not in the ground, the metal's not in the ground. They're going to have to find it. If mining has happened a lot in a certain class, such as gold, you will see that grades have gone down on a lot of big mines. So the next mine that they find will also be of lower quality. So it'll take more time to get the same amount of material out of the ground. It's just a fact of reality. So the raw resources are always going to work on an auction bid process. And if there's just enough producers buying their resources, they're just going to have a lot of demand. And there can be more producers bidding for their resources because we can just expand production capacity with more machines. But we can't expand the resources that are in the ground. So the raw resource producers will just quote an obscene price to the producer. Whichever one buys it will pay it, because if they're the only ones who can produce, they're the only ones who can get income. So that's good for their business. They will just produce at a higher cost. Now, the shops will just go for a bidding process as well, because if they don't have anything in their store shelves, they can't sell anything. So that jacks up the price in that part of the chain. And instead of having basically no inflation until everyone runs out of stock, you're going to get triple inflation from the raw resource producer that quotes more, the producer that quotes more, and the shop that quotes more, because everyone along the chain has to earn money. And that's when you're going to see goods really explode in price, which November this year, December this year, maybe after the Christmas season, because everyone will spend while everything is open. And if there's another scare towards the winter next year, or everyone's going to cut their spending, it's going to be bad. But as a reaction, all that's still in stock will see a discount in stores, because, stores still got to sell something. That'll be around the Christmas season. And after the Christmas season, there's just no reason for anyone to spend anything, and everyone's broke.
Yeah, not to mention on the day the yield curve control is announced, just imagine how all the commodities are just going to spike in price, all the raw resources that are the inputs to all these goods, and that'll cause them all to go up too.
And that is going to cause all the prices for everything to go up, because, raw resources are used in many different goods per resource, because it's all elements. And by the third or fourth cycle, like after Christmas next year, you're going to see far more stimulus handed out to people than you can imagine. Like a $10,000 stimulus payment is in the very near future. And everyone thinks, yay, great, 10,000. No. The reason why that's in the future is because commodity prices are going to go up so fast that everyone in America is going to need more money. Right now, something like 25% or 30% of all income in America comes from the government or something. Insane number. I don't know it exactly, but it's insane anyway. And those people are going to ask daddy for more money. Daddy's going to give it because otherwise daddy's going to get a revolt. So that $10,000 stimulus is going to morph into a $25,000 stimulus check by middle of next year. And by the end of next year, you're going to see monthly $10,000 stimulus checks handed out at the minimum.
Yeah, I agree, because it seems like, just like the drug addict analogy, like the more drugs you give a drug addict, the more they want. But if you take any of it away, right?
I understand the analogy, and that would have been correct last year. Currently, it's much worse. You can basically see this as a gunshot victim. The bond market or the dollar, pick whichever one you want. Both have been shot. You can save one by patching it up, and that's the yield curve control that's coming. But it just means that the other one's going to bleed out. And the brilliant idea that they're going to have is, well, if he loses a liter of blood a minute, if we just pump another liter of blood in his veins in that time, it's going to live. So
that's right.
That is exactly what is going to happen to the fucking currency. It's basically some comical cartoon character that's already been shot and bleeding out, but they put an IV into him, and that is going to save his life for a while, and then somebody walks by and shoots him again. They're just going to get a bigger pump to pump more blood into him. At some point, you're going to get a geyser.
Absolutely. So let's talk about what some of those bullet holes are going to be, right? Some of the upcoming gunshots to the already wounded victims. So don't you think that people are going to demand more stimulus checks, right? Like you're saying, 10,000, right? Because now they're all hooked. Don't you think?
Up until now, it was, well, I wouldn't even say now, because I definitely do not want to be disrespectful to the people who really need these stimulus checks because they are destitute. And I feel for them, but there's nothing I can do. There's nothing anyone can do for them. That's simply the process of hyperinflation, the currency becoming worth less and less and less. And the first ones who are going to fail are the ones who have the least amount of capital. So, they are going to need those stimulus checks to buy food.
Yeah, exactly. You're right. And at this point, they need the stimulus checks, and they're going to need more and more and more, because that is how irreparable the economy is, right?
Yeah.
So great. So that's one need for them to bleed more and more cash, right? The government to print more and more. Another one, which is really interesting because it has to do with some of the really insightful research that you did, right? Another use for government funds is going to be to patch up potentially the U.S. mortgage market, right?
Yes.
So if you
latest call for calamity.
Yeah, exactly. So could you talk a little bit about what the real issues are in the U.S. mortgage market that you've seen?
Well, there's basically two parts. We'll talk about the residential housing market today, but I just want to quickly go through the commercial housing market. No, not the commercial market, the commercial mortgage market, the CMBS. Basically, it's dead. I have no other way to describe it. I saw a presentation from Jeffrey Gundlach, and where he broke down the corporate mortgage market bonds by rating. So the AAA, the AA, the A's, and the triple B's. I had already known and seen and warned people about that the CMBS market was sliding because there's an ETF, or there's two ETFs actually, that track the bonds of these markets. One is LQD, which is investment grade, and there's HYG, which is junk bonds, basically. And the weird thing is LQD has started to slide and is down considerably already. while HYG started to slide later and isn't down that much, and comparatively, of course. And the strange thing is that's not what you would expect. You would expect the investment grades, the lower risk ones, to go later than the higher risk ones. So I already did some research into that, and I basically concluded, well, the corporate market is dead, and the lockdowns have killed it. It's too much, and it's now dying. But that still didn't explain LQD. And I saw in a presentation of Gundlach that it's actually the AAA tranches that have been sliding the most. If we talk about the order of in which bonds have been declining in value, then the AAA tranches are down the most and went the quickest. The AA tranches are already down. The a single A tranche has stopped moving up, and the triple B tranche is still going to the sky, which basically tells me that the Federal Reserve, well, we know the Federal Reserve is in the markets, and we know they buy $30 billion in MBS a month. I know via BlackRock, they must still be buying LQD and HYG, but they must have focused so much on the junk debt, the shale debt, the zombie companies and such, that they completely forgot to think about the better companies, the ones where they thought, well, they're not going to need the money because they'll live. Stuff's been shut down so long now that that's no longer true, and the AAA tranches have started to slide. They are down considerably, and that's a paradigm shift. That's a sea change. That just means that the entire CMBS market is now dead. The bonds there has to be too much defaults, otherwise they wouldn't be sliding. But you can't see it in the lower yields because they are artificially bought. But again, because this is basically 2008 all over again, or maybe even 2007. I think we are very close to Bear Stearns, that point in the previous collapse. But they basically did it again. They basically stuffed the AAA tranches with shit. And because the Federal Reserve thought, well, we only need to support the lower tranches, that's basically what they did. No one put any money into the AAA tranches. They were left to fend on themselves, and now they're gone.
But let's just summarize that. And in addition to U.S. government bonds, the Federal Reserve is going to have to prop up corporate bonds, right? So that's just another bleed.
So of the 120 billion a month that is now going on in QE, 90 billion is U.S. Treasuries and 30 billion is mortgage bonds. Well, the 90 billion is going to go up with yield curve control, but the 30 billion in mortgage bonds is going to triple, if not quadruple, in the very short term. Otherwise, the market's just going to drop.
Right. Absolutely. So let's move on to the mortgage bonds, residential.
Right. So I sent you over a couple of pictures, and let's start with the first one. The MBB, MBS, ETF, LOL. So this is a fact sheet of a ETF which tracks mortgage bonds. So since I know that the corporate mortgage bonds is sliding, I was wondering if the spike in yields maybe didn't have an effect on the normal residential market. I knew that Wall Street had done the same thing as they did last time, just repackage shit. But the question is, so how bad is it? Well, I wanted to look into this. And because I'm a big fan of the movie The Big Short, and I've seen it multiple times, I basically went with the start of it. I looked. So since we live in the age of ETFs and everything's digital and easily to find online, and because of my research in the gold space, I know that you can download the prospectus of SLV and it has all the bars with the serial numbers in it. So I know that I could somewhere download a holdings of an ETF and see what bonds were in them. And I actually found it. It's not like it's really hard to find, but, I went through the trouble. However, first, let's talk about the fact sheet and the most important thing that I put on there. It's a Photoshop picture because the credit ratings are a few pages down, and I just wanted to have the summary there as well. The credits ratings breakdown is absolute bullshit. 99.59% AAA rated. Yeah. Now, just saying those numbers out loud, you already know there's some bullshit in there. But the question again is, how bad is it? Like if they lied about 3 or 4%, no one's going to care. So, again, I just looked at the bonds. This is a $25.3 billion net assets ETF. So it's a considerable amount of money. So in the second picture, which is a bit convoluted, but don't worry, I'll explain it all. You basically see what's in them. As you can see, it's called MBB_holdings. Well, that's how I saved it, but these are basically the bonds that are in the ETF, and I did a search for certain keywords. When I was just looking through the names, it doesn't say anything about any of the bonds. It literally is just a list of products. I tried looking for them on the internet, and there was no way I could see what was in an individual one of these. I think many names are duplicates, so there's no way to tell. However, when scrolling through them, I did notice FICO under 660. Now, I'm not an American, so I am not up to date on what FICO score is a good one. But again, I have seen The Big Short, and I remember Jared Vennett saying that there were some AAA or AA rated bonds, which he knew for a fact were filled with a large percentage of dog shit of FICO scores below 550. All right. So, well, I know that that's very low. So I just thought, well, why not look up what the FICO scores are in America? And apparently, according to Google, a FICO score below 670 is considered below average. Now, I'm not that good with words. So below average, I'm not sure if that's AAA rated, but I think it is, you know. There's so many of these bonds in there. You would say, yeah, this is clearly 99.59% AAA rated. But aside from the FICO scores, a lot of these other names don't make sense, so there's no way to track those. I accidentally put one of the search results over the scroll bar, but the FICO score scroll bar is about as large as the LTV scroll bar, because that's what I noticed. I noticed that these FICO score things all gave 4%, 3.5%. They gave those kind of returns. And I looked through the list, what else gave those returns, and saw LTV. Well, that's a definition I can Google, surely. So I Googled it. It says loan to value. Well, it basically means that a certain percentage of loans is expected to default. And when the loan to value tells you what that percentage is, more or less. Now, there's a lot of difficult calculations involved, so I'm not sure at all on this. However, if I see I know a product's name have to be somewhat recognizable. So if I see LTV over 90, I'm going to figure that less than 10% of the loans in there are going to default. I think that's a reasonable conclusion to make based on logic. Well, I basically did a search for LTV over 90 then, and that's the second search result that popped up on the rightmost. And you can see there's a lot of loans in here with an LTV just over 90. And I'm not sure if 10% default rates are AAA rated, but I'm not much of an investor, but I wouldn't put my money on that. If somebody gives me like a 10% default rate on a AAA rated bond. However, just to handle the last search result, I noticed something similar between the low FICO scores result and the low LTV scores result, and that is the percentages you got. Four, a lot of fours, some fives even, 4.5%. So I didn't see anything over 5. So I thought, you know what? Let's pick a high percentage and just search for a percentage. Which one of these names has a 4.5% return on a mortgage bond with rates at historic lows, right? Which one of those, what would be the names of a bond like that? So I just searched for 4.5%, and that's the middle column. That is quite considerably large. So those are the highest yielding bonds in this thing. And a couple of them say LTV over 95. That's a good one. The fourth one from the top in the middle search result says that's a Fannie 30-year guaranteed loan that yields 4.5%, has an LTV over 95, and comes from 2019. Now you tell me where you could find those rates on 30 years bonds in AAA bonds in 2008. What's in that bond? Hollywood star houses?
Right. Yeah.
and that's not the only one out there, because there's another one a few numbers down the list. And there's another one a couple of numbers down the list. There's a lot of Hollywood houses in this ETF. There's only one logical conclusion to make here. It's filled with dog shit. None of this is AAA rated. Literally none of this is AAA rated. If I were to own a rating agency, I doubt I could find a single bond in this thing that goes over a AA rating. And that's being conservative.
Yep. And it's really interesting because they're using the exact same logic as 2008, right? Bundle together enough of these mortgages, then it becomes a safe security, right? And real estate always rises. So
don't forget to hide it and make it also as complex as possible and put it at the bottom of a page somewhere. And don't forget, no one ever looks at the holdings.
Yeah. And luckily,
it's not just the banks that are making the same mistakes as 2008. It's the general populace as well, because I assure you, no single soul looked at these fucking numbers.
Right. Except for you.
Yeah, because I'm just a stubborn son of a bitch.
Right. Well, it's interesting because this is also in the middle of the worst economy since the Great Depression, right?
Oh, yeah.
So how could you call these AAA rated when people are suffering, right?
I don't even know if the banks are going to be alive in 3 months. I don't know if there's even going to be a digital system to transact currency with. And that's much systemic risk is there now. That means that nothing's AAA rated.
Yeah, absolutely. But there you go. We have the Fed, right? And they're going to sacrifice the dollar on the altar of keeping this stuff alive, right?
Well, the problem is it's already too late, because that's something I've been saying since early last year, and that is simply that the problem is too big. Well, if you want to give out stimulus, that's fine. You can even just give out stimulus to people when it's justified without impacting the economy negatively. It's even already happened within American borders. I can't remember the date, but I think it was before 2008 when the oil price was very high. Alaska had a budget surplus because they got a lot of oil revenues. And rather than spend more money, they actually returned some oil revenues to the taxpayers. So everyone got around a $2,300 stimulus check, which wasn't a stimulus check. It was just literally oil revenues. But since every taxpayer got it, you can legitimately say that's a form of UBI, Universal Basic Income. The only difference is it's labor justified because it's income from oil revenues. It's not printed by a money printer. So it's not the tools you use, it's how you use them. And the Federal Reserve can't use any tools that they have, which the only tool they have is printing money. Stop talking about the Fed having tools. The only thing they can do is print fucking money. And it's run out of steam.
Yeah,
they just can't print more. Obviously, they can print more. They can run a press, but they can't print more because money is debt. We're in a solvency crisis that's going into a crisis of faith. If you add more debt to the crisis of faith, I am not going to solve something when I've got a C credit rating by pushing it into a D credit rating. That's not going to have the people asking for their money back get less worried that money's not going to come back. Come on. But that's where we're at.
Yep. And that's kind of a really important question is, when does the full crisis happen? Because gold bugs since 2008 have been decrying, right? The printing of money and it hasn't materialized in the hyperinflation story, but you think this will finally trigger the loss of confidence in the dollar instead of just having the Fed continue to pull wool over people's eyes?
I want to correct you there, because you say, when will when will this stuff start to affect everything? Now, today, it's already happening. Let's go to the third picture I sent you from Fannie Mae. Again, a lot of numbers, but again, I will explain everything to you. Since I basically knew that the MBB ETF is full of shit, and I also know that it's been dropping, so that's the difference. That's why now the situation is different from last year, because last year the MBB ETF was still going up. Right now, it's no longer going up, it's going down, and it dropped considerably with the spike in rates.
Yeah.
So trying to track this, I wanted to see if I could find fraud rates and default rates, because again, thanks to the Big Short, thanks to Michael Burry, it's been the very intro that if fraud rates are going up, then there's a housing bubble. Well, it's not that one-on-one, but you know what I'm talking about. It's just that general thing. So I couldn't find any fraud number. Well, I was looking more for Canada specifically, because that's market screwed too, but that's not a video. And I couldn't find any. So I looked for mortgage delinquency rates. Now, I also happen to know that America right now is basically, a lot of people are defaulting, but it's being hidden by forbearance and deferrals. So a lot of people stop paying their mortgage, but it's not showing up in the system because they're allowed to. And the banks aren't allowed to do anything about it, or the landlords aren't doing anything about it. But there's always a price. So I found Fannie Mae's quarterly, basically. And in there, their financial results and everything, is a table called Fannie Mae, MBS, and other guarantees. So that's the mortgage market which Fannie Mae guarantees, as it's a government. Well, I don't need to tell you guys how Fannie Mae works. Now, I figured there had to be a number somewhere that stood out. And the number on the entire balance sheet that stood out to me was the liquidation rate in this table. I do know what liquidation means, and it never means something good. So in the explanation of the table, it basically says liquidations represents the total amounts of repayments, curtailments, payoffs, and foreclosures on mortgages underlying Fannie Mae MBS, including Fannie Mae MBS held in the retained mortgage portfolio, which is their own portfolio. Now, in the previous screenshot, you already saw FNMA bonds come by, which is the Fannie Mae Corporation. They renamed it to that, or that's their ticker. And so we know that these are the bonds. They guarantee these bonds in the ETF. So we have a link. Well, there's 4 words in the explanation: repayments, curtailments, payoffs, and foreclosures. This is one number for 4 categories, if you will. And we cannot reliably say how much of the number is payments and how much of the number is foreclosures. But we can realistically follow world events, world situations. We know what happened last year. Last year's history, COVID. And we know what happened in 2019, this is the repo crisis. So by comparing a previous situation with the current situation and putting into worldview context, we can get a pretty good idea what the majority of the number of liquidations is about. Now, considering that there is basically legal forbearance and deferrals in place all over America, I don't think the amount of repayments have gone up. I also don't think the amount of payoffs have gone up. At the same time, I don't think the amount of foreclosures has gone up. I think it's even gone down because people aren't allowed to be foreclosed. It does happen. Again, I don't want to discount anyone's suffering, but compared to how much it should happen, it's not. That's just not happening because it's not allowed. Well, that just leaves one word: curtailments. And curtailments sounds to me like it contains deferrals and forbearance. Basically, stuff that ought to be paid but isn't paid now. It basically, again, if the renter doesn't pay and the landlord doesn't pay, well, then the mortgage owner pays. If the money doesn't come in, the money doesn't come in. It's that simple. And if the money doesn't come into Fannie Mae, they're going to have to write it off. And I figure that's called somewhere in the vicinity of liquidations. So that number is 40% year to date in January 2021 is quite unnerving. That it spiked to 42.1% November last year. I can do what I do because sometimes I see numbers and I get anxious, or I feel nervous, or I even feel scared. When I look at that column after, say, April of 2020, the voice in my head is just laughing. This is such an unspeakable disaster. I don't have the words. Now, of course, I have to check if I'm right on this because I don't want to cause a fuss over nothing. So since I'm not an expert, the only thing I can do is, well, if I go back in time and compare it to when I know the market was just humming along fine, then I can see what the numbers were back then and compare them to the numbers now. And we can see, a relative difference. And that'll tell me more about how the situation's escalated. So going back to the very top of the screenshot, January 2018, the annualized liquidation rate was 14.6%. Seems high to me, but what do I know? So whatever, I'll just accept it as that's normal for a situation in 2018. There was a market dip in 2018, but it happened in December. So we can really reasonably say that from January 2018 to, say, July 2018, before problems under the hood started developing, because they always happen up front, that's just normal market data. That's just how life is. And during that period, you can expect to see between 40 billion and 50 billion in issuances from Fannie Mae, and they liquidate about 14 to 15% of them, or 12%, even lower. Fine, great, looks good. Now, we know in 2018, the market crashed and Fed cut rates and rates went down and everything. And you can actually see the liquidation rate drop in the starting of 2019, down to 11%, down to 10%. That seems low, but, fine. Afterwards, they start climbing. Now, in September 2019, the Reaper crisis happens. That's my area, so I know plenty about the Reaper crisis. And I know that, that has to have an effect on rates because, crisis. And you can actually see that going towards the Reaper crisis as early as August 2019, the liquidation rate already spiked to 19.9%. In fact, in June, it already went to 17%, which compared to everything before that in the last year, a year and a half even, that is quite high. So had anybody been watching that, maybe they could have predicted the Reaper crisis, but who knows? That's ancient history now. But as we continue through the Reaper crisis from November and December, you can actually see rates going down again as more QE was printed and more rate cuts were made going into COVID. It actually dropped in February to 18% right before the crash, and then it starts going up. It's 20% in March, 26% in April, 33% in May, 36% in July, and well, the rest I already talked about. So knowing the macroeconomic situation as I do, clearly, the worse the macroeconomic situation gets, the higher the liquidation rate goes, which means it's not a good thing. So the fact that it is at 40% is really not a good thing. And before we move to another picture, I want to point out something else that has changed. That the issuances have, since the repo crisis, basically, or well, actually since August, the year 2019, have absolutely exploded. They went from between 30 and 50,000, 30 billion on the paper, thousand, but between 30 to 50 billion up to July, and now they're 150 billion in January 2021. Increasing violently. That's the only way I can describe it in 2020. In January, 65 billion. February, 60 billion. March, 73. April, 106. May, 130. It actually went down to July, but then in August, when they had nearly 37% liquidation rates, it's 140 billion. And when they had 160 billion in November 2020, which was also their highest printout at a 42.1% liquidation rate. All I can say is, damn.
Yeah.
Damn. And just to add insult to injury, that's the last screenshot that I sent you, because as always, since I have no historical reference for this, I need to basically look at the past, at other situations that were bad in macroeconomic sense. We've been through this before, so we have a very good blueprint for what's going to happen, and that's 2019 or 2009. I mean, sorry. And you can see from the last screenshot that in January 2009, the annualized liquidation rate was 11.5%, and then it started going up to 19.6, 26.5, basically 25, 25, 28, 27, 22, 19, 17, 20, 18. And in January of 2010, it was 23%. So that's the year after the legendary housing crash. And the numbers are double now. Even worse, what I haven't sent you in screenshot is that I went through all the years and we've never reached 40% before. The highest I've seen was somewhere, I thought 36.8% somewhere in July 2012 or 2013. Not that long before rates suddenly normalized in 2014, where the liquidation rates out of nowhere dropped to 14%. So I now have historical context. I have a good idea what what liquidation rate means. And again, in 2009, you can see how the issuances went, where suddenly in May 2009 and June 2009, the issuances jumped to 129 billion and 130 billion. So there's also precedent for issuances jumping in the middle of a crisis. So
yeah, I think you've definitely done some good DD on this, because you found a seriously festering issue that seems pretty obvious in the mortgage market, and it just, the only conclusion you can draw is that it's going to be another hole for the Federal Reserve to fill, right? With printed money.
I don't think they can fill this hole. Don't quote that out of context.
Well, Zimbabwe filled holes, right? I mean, yeah.
The point is, manipulation doesn't work like that. The way manipulation works is basically like, according to the saying of Abraham Lincoln, you can fool some of the people all the time. You can fool all the people some of the time, but you can't fool all the people all the time. And that is what the Fed is basically trying to do. And that's why everything's crashing now.
Yep.
But how they've managed up until this point is they focus your attention on something that doesn't really matter, but they make a big deal out of it. Now, if it's something everyone's attention is already focused on, then it's just all the easier. You just pump it up and everyone gets even more excited. If you look at the Federal Reserve's secondary market facility, basically how they buy ETFs through their BlackRock flunkies, they're filled with bonds of names you know: Apple, Berkshire Hathaway, Microsoft, Facebook, Netflix, Tesla, all big names. If you look through them and you start looking at medium to small size companies who could really use the money, nowhere, no one, none to be found, not a single one, zip, zilch, nada, nix. And the reason for that is very simple. It's because everyone's looking at Tesla, everyone's looking at Apple, everyone's looking at Microsoft. So if you just make those one go up, you can just fake it until you make it for the rest of the market.
Boost the S&P 500, right?
Yeah. Let's put it another way. Gold miners were already severely depressed at the start of last year. All right, they were going up a little because the price was finally going up a little, but that was also only because of the Federal Reserve's money printing. So severely depressed companies that had to suffer at the end of a very long bear market dropped like a brick in the crisis. But how many of their bonds did the Fed buy? How many bonds of gold miners will the Fed ever buy? None. Because the Fed does not want your attention anywhere near gold. Because if too many people look at gold or silver, the entire system breaks in a day. The Fed has been saying for years, we have these tools in our toolbox. We can do this, we can do this, we can do this. Now they need to put up or shut up. And the last meeting last night basically said, or yesterday, they're not going to do anything. They're not shutting up either, which would be a nice change, but they're definitely not putting up. They're not increasing QE. They didn't do yield curve control. They didn't even announce anything on the SLR yesterday. They did say that they were going to have a comment on it soon, but the current narrative in the markets is that rate yields are spiking on the basis of worries that the SLR will not get extended. And today they have something to say soon about that. I already know this market narrative. Everyone knows this market narrative. Zero Hedge is posting constantly about it. So, of course they have to know, but they apparently don't care, or they don't know. And I'm starting to lean towards incompetence, which means they don't know. They seriously just don't understand. So, what you can do, bruh? What you can do, bruh? Come at me, bruh. Come at me, bruh.
Right.
I mean, there's nothing. Right. It's not that they're out of ammo. It's that they were always shooting blanks to begin with.
Have you given thought to the U.S. dollar's reserve status? Because doesn't that seem threatened in the event of this massive money printing?
Well, in the case of the dollar, I think it's simply a case of there is no alternative until there is. Now, I know people think gold is an alternative, but it's not. Simply because gold cannot be digitized. We cannot transact with gold digitally. We can implement a gold standard, but a gold standard is always a gold promise. It's a promise to gold because you're not digitally trading gold. You're digitally trading a representative for that gold. It would be a better system than we have now, but make no mistake, you can only digitize a promise. So since gold cannot be digitized and trade cannot slow down back to the level of shipping gold around the world, it's not going to be gold standard. Gold will have its place as a reserve asset. As a brick gold, it still has value. It's still an element. It still can be used in industry. It looks nice, etc., etc., etc. But what the alternative will be for a global reserve currency, there is none. That doesn't mean that people will stick with the dollar. It just means that we're going to have the market decide this time. We're going to find something that's going to interact as a good intermediary. And at this point, it could be anything. It could even be Bitcoin for a while. Now, Bitcoin is still worthless and still going to go to zero, but that doesn't mean they won't try. Before it goes to zero, look, if Bitcoin is the third currency they try and goes to zero, then it's just the third currency they tried, and the system's going to go for the fourth. If you want to know how long this can go on, just look at Venezuela. As long as the army chooses the side of the government, very long, very long, much longer than anyone is comfortable with. So it's very possible that we'll see 3 or 4 global reserve currencies in short order, which is just going to be digital systems switching from a lot of one fiat currency to a lot of another fiat currency until that one explodes. I really can't say. It could be crypto, some form of crypto. It could even be kinesis, which is basically another gold-backed crypto. But another way of doing it. I mean, a smart way. But it's still I don't know. The market's going to decide because everyone's lost faith in the central planners. So that's not the people who are going to determine the new currency. You can see that in every other centrally planned country that failed. What they then do is they implement a dollar standard, because while the currency is flailing, this might even be a better word, people are going to trade something else. No one's going to hold a deprecating currency. No one's going to do that. The only reason people are doing it now is because they simply have no idea. But the moment it's made clear to them that the currency is not going to be worth anything anymore, they're going to find any alternative. We might even see Fallout style, like the video game Fallout style bottle caps as a currency, because you simply cannot make bottle caps infinitely and you can't print money infinitely. It doesn't have to have value itself. It just has to be an intermediary that works until we produce too much of it, and then we'll just switch to another system. I'm not saying this is a good thing. I'm not saying this isn't going to be total chaos, economic collapse, and basically financial Armageddon. It's here. The end is really fucking nigh. But that's just the situation we're in now. The system's not just fucked up. It's fucked up for too long. All good things must come to an end. And this is the end. It's that simple.
Yeah. At the end of the day, it would just be a debate over when, not if. So yeah. So when the U.S. currency deflates or inflates, right? Mm-hmm. How do you not only protect your wealth, right? Anyone can buy gold. How do you be a true early stage investor and buy some assets that will do astronomically well?
Well, there's 2 ways you got to look at this. On the one hand, you have to have physical gold and silver. There's no way around it. I would like to say, look, there's this amazing opportunity out there which you can just use to sell, buy everything. No, even Warren Buffett's wrong. You need gold this time. You need silver. You need something physical, because in our modern society, gold is useless for 99% of the time. Even in industry, because we do want to use it in industry, but because we see it as money, we try to avoid using it in industry as much as we can. We have many substitutes. It doesn't mean that gold isn't worthless, and if we never have to use it as money again, you're going to see some new industrial applications that are going to wow you, probably, because we value gold too much right now to explore them, but they're there. But that 1% of history where gold is the ultimate backup, the ultimate way of protecting yourself, because the system fucked up so hard and everyone's looking in the wrong direction, that you have this one chance to not only protect yourself, but actually make a lot of money out of it, because it's simple supply and demand is psychological. There's going to be a time where all these overvalued houses are going to be worth nothing because you can't eat wood, you can't eat concrete, you can't eat brick. People are going to be starving because food has risen so much in currency that they can no longer afford food. They have to find some way to get food because you can't no longer say, oh, I'm just going to wait for food to be available again. No, people, if all your food goes away today, you have a lifespan of a week at most. There is no waiting here. If you have to sell your house to eat tonight, you will. And that's the kind of situation we're going to. And if you can offer other people currency, it's likely they won't take it because, you know, the currency is deprecating so fast and a house is a very large purchase, usually. So they would like exponentially more amounts of currencies for it. And, well, that's just going to be a problem generating those currencies. So if you can give them gold or silver or something else that holds their value, but for the uninitiated, just stick with gold and silver or platinum. Platinum's fine, but most people don't want platinum because they have no experience with it. Everyone knows gold and silver. Everyone knows gold and silver is the backup, so it is the most liquid, and that's what you want.
Yeah. So
that's just what's going to end up happening. Buy a couple of small ounce coins. I recently bought 21 fourth ounce silver coins because I happen to know in Venezuela, 1 ounce silver coin buys your family 6 months of food.
Wow.
Yeah, this is not a joke. This is a matter of survival. You need to buy that shit now because it's running out very quickly with the Wall Street silver squeeze. Go over to reddit.com/r/Wall Street Silver and join the community and do it quickly because you're running out of time. This shit is not going to be available much longer, and it's the only way to protect yourself. But again, if a 1 ounce coin feeds a family for 6 months or a single person for 6 months, there's not a lot of foodstuffs that stay good for 6 months. So if I buy 1/4 ounce coins, I can buy basically 1/4 at a time, which is a month and a half worth of food, which should be doable.
Yeah, and then see, that's not preserving the value of your wealth. That's
just being fucking smart.
I mean, no, but really, that's true. But I mean, it's not like gold where, like, you know, 1 ounce of gold will buy the X number of barrels of oil, right? No matter what hyperinflation is. Silver, it seems like, you know, right now it'll buy maybe a meal, but you're saying in hyperinflationary societies like Venezuela, it buys 6 months worth of meals. That is a serious return on that ounce of silver.
Yeah, but this is not a situation where you can think in terms of returns because those 1/4 ounce coins I bought at a 1 ounce price of about 40 euros at the same time where 1 ounce coins were about 32 euros. So I paid a very large premium for those 20 coins. But I don't look at those because if you buy 6 months worth of food with 1 ounce coins, then you're going to have to consume 6 months worth of food or you're going to waste the coin. And then the future is a situation where you're not going to be wanting to waste that money because there's going to be a lot more assets that you can buy with silver. Houses, cars, assets, anything. But what you need to understand is that the only reason you can buy that shit that cheaply with silver is because you're going to look some very destitute people in their eyes and you're going to rip them off because those are the market rates. And the only reason you're going to do that, even though right now you're thinking that's never what I was going to do. No, you're going to do that because that's the only course of action left, because we are now living in a every man for himself situation. And you shouldn't even worry about the people you are ripping their heart out for their house for just a few ounces of silver, because their neighbor next door, the house you didn't buy, is going to starve.
Yeah, I gotcha. Wow. So then in this kind of society and you know, environment that you're thinking will be the future, where do the shares of miners come in? Like, what does that look like?
So that's the other way to protect yourself from inflation. People need to understand that the markets aren't going to go away. There's going to be very funky shit happening. You can just look at the Venezuelan stock market. which has gone parabolic, but it's worth nothing. And that's basically what is going to happen to most markets. They're going to crash. Of course, there's going to be a massive rotation out of non-inflation protective assets to inflation protective assets like gold miners. But after that, dollar values are starting to go through the roof, not because the companies go up, but because the dollar goes down. Regardless, people will still use an intermediary. And if you spend everything immediately, there's not much of a problem. Like if there's 10% inflation a day, that is a problem if you need to eat today, eat tomorrow, eat the day after, eat the day after. But if you have, say, a car company, which you thought would do well, but is now lagging behind the rest in hyperinflation, and you rotate out of it, so you take your profits. If you then immediately, within a minute, buy another company with those profits, the value of those dollars or whatever currency it is hasn't deprecated that much. Not within a minute. You can't hold on to it for a day. So whenever you sell anything for the currency, make sure you have a buyer or a way to spend it lined up, ready to go immediately. You do not want to hold on to it any more seconds than you want to. But there's still going to be companies that are going to be outrunning hyperinflation. Gold miners, silver miners are one of them because they literally produce the gold. So as gold goes up in demand, they're just going to receive more currency, and that eventually they're going to just pass it on to shareholders. So if more and more people want more and more gold, then the gold miners are going to just ask a higher and higher price, and it doesn't really matter what inflation is because it will just get added on top of that. So we're going to start as inflation as a basis. Well, the gold we pulled out of the ground last week cost 1,000. This week it's going to cost 1,200. So we're just going to put it at 1,200. But as I explained earlier, because supply chains work on an auction process, if there's an outsized demand for it, the miner's just going to say, all right, well, we pulled it out of the ground for 1,000 last month. We pulled it out of the ground for 1,200 now. We're going to start the bidding at 1,210, so we have a little bit of a profit. Who wants to buy it? Someone buys it for 12,000. Well, they're just going to return that cash to the shareholders. And while they might need to generate $200 more to outpace inflation, they easily did that. And you're going to get cash on top of that because there's an outsized demand.
Right. Mining shares will outrun inflation, which will be very incredible to see, right?
Yes. And there's another reason why to own mining shares. Well, companies in general, it doesn't even have to be a gold miner, a platinum miner, again. Stuff that's rare, comes out of the ground, can be printed, has industrial use, needs to be used, etc., etc. The gold is the main asset that everyone knows, and it will do the best in that situation. But silver, because there's more of it, it's cheaper, so it's easier to spend, and therefore silver does better. But at some point, the system's going to reset. Obviously, I don't know when, and I don't know how it's going to look like, but at some point, we are going to need a new intermediary because the dollars become untenable. It's inflating with like 4% a minute, and no one can trade like that. So the reason why you want to hold on to shares all the way through that event is because when the event is over and the new currency is established, and let's assume for a moment that it actually works, everything you own that generates currency will start generating new currency. Now let's, just for ease for a moment, consider that the new currency is gold. It's just gold again. We're back on the gold standard. It's something everyone knows. Well, if you own a income generating business like real estate and it starts generating income for you in the new currency, effectively you're minting gold. You are earning currency that is a gold standard, so you are earning gold. You don't need to earn a gold. You don't need to have a gold miner. But that requires you to actually own an income-producing asset.
Right.
So what's going to happen just before the old currency dies is that income-producing assets, which don't produce goods like gold, but only produce assets like real estate or tech companies, growth stocks especially, they're going to be dirt cheap because they generate currency no one fucking wants. And they're not very good at generating currency either. Banks are a lot better at generating currency than tech companies. So no one's going to want to buy them. That's exactly the moment I want to buy them. Because the moment hyperinflation ends, gold is going to revalue to a lot lower compared to everything else because the demand for it will end. Again, gold is only useful in that 1% of the situation where demand gets completely out of control and everyone goes back to the old backup, which is gold. But once the situation is back under control, that demand for gold will start to slump off and die. Now, it won't go as low as it is now. Even if the dollar didn't die and we live to see another 10 years of bullshit, then gold will just go up to say like 100K an ounce, and then it crashes back down to, well, if it's 2,000 now, it'll crash down to like 1,200, something like that. So it's always going to level off at a much higher level than it is now. You're always going to have gains, even if you hold through everything, but it's going to spike because of demand. And at some point in the future, that demand's also going to drop off again, and then gold's going to sell off. And you want to be out of gold before that happens. And once gold is going to sell off, that money is just going to relocate to another thing. Just like it's going to go to gold now, it's going to go away from gold later. And just as it's going to come out of real estate right now, it's going to go into real estate later. It's just that if you time the moments of that switch correctly, you can make so much money. It's so much ridiculous amounts of money. And that moment to switch is right now. If you're still in real estate, this is a perfect moment. Because since we mentioned gold stocks, let's talk about some stocks. I'm not going to go deep into any company specifically because that's not the purpose of this video. But I wanted to mention Yamana Gold regardless, because it's an extremely good company, and I called the bottom on this thing. Because on a stream I was doing in the weekend between the 26th of February and the 1st of March, I kept pounding the table on Yamana, like, this is such a good deal. Every single financial statistic they have is very good. Their dividends are going parabolic, for God's sake. They're very low on debt. Their revenues are going up. They're not even just a gold company. They're gold and silver hybrid, so they have exposure to the silver price as well, which we know is in supply deficit. They have and have had for months a solid dividend plan where they are planning to create a cash buffer so that if there's ever a market drop that would affect dividends, they would actually pay dividends from the buffer. So you have dividend protection of everything else. And the forward dividends is something like 3%. And that was like a percent a year ago. There is no fucking reason for the company to be that low. So I was just pounding the table for that for like an hour or something. Someone actually bought that bottom at $4, and now it's $4.66. So it's already gone up like 16.5% from that bottom, and that was 2 weeks ago. So the majority of your gains is going to come from the last leg of the bull run. Even if you put money into gold miners now, you're going to see decent returns for quite a while. And then in a year or something from now, even when hyperinflation happens, and because so many currencies are going to hyperinflate at the same time, this can last a heck of a lot longer than you think it can, or even I think it can. But during that time, profits are going to be good. But towards the end, when the curve really goes exponential and the order of the magnitudes goes up, that's where you get most of the gains. You're going to be holding for quite a while. And the most important thing you can have to make it through this is some character. Just don't chicken out. Just wait for it. You know when things are getting bad. You know when things are going to get worse. You know when things are worse. Because you're literally going to see people begging in the streets and selling cars for nothing. Because they need food. Yep. And at that point, I'm just going to wait. Wait until there's, as they say, blood in the streets. Only this time it's going to be literal.
Yeah, and it's funny. It's like a lot of these stocks, like you shouldn't worry about the timing because a lot of these spacing patterns, I feel like in 20 years, you're not even going to be able to see them on the chart, right? They're just going to all blend into the bottom little left-hand corner.
Yeah.
And, I mean.
And that's what I said with the 1/4 ounce coins. I bought those at an insane premium compared to the single ounce price, but I'm not looking at the premiums. People, and I've had discussions with people who have messaged me over the past months, and I basically told many of them, you're all looking at cents, all right? It's insane. We're expecting the price of silver to go to $200, and you're worrying if you should get in at 26.4 or 26.5.
Right?
Really? You bunch of greedy motherfuckers! You all ain't learned shit. You all just gonna hold on to your silver and you write it down again because you got no idea of values. You get no idea when to sell. You kidding me?
Yep, exactly. That's why
I would burn those 21/4 ounce coins and just toss them to random people on the streets if I thought I could help them and I have enough money myself. I don't give a shit. What I'm worried about is that I'm going to be standing in a supermarket or in front of a farmer because supermarkets are going to be empty by then. And I'm going to work out how I'm going to eat 3 months worth of potatoes that are going to stay good for 3 months and how I'm going to eat those in 6 months when I don't have that much food requirements. It's a complete different way of thinking. I'm not looking at the price. I'm not looking at the premiums. I don't give a fuck. I want to be able to just buy a month or 2 months of food instead of 6 months when shit has hit the fan.
Right. It's like saying, I should have bought Apple at $6 in the 70s versus $8 like I did, right?
Yeah. No, it's saying like Apple started at $4. It's now at $12, and you're not going to buy it because you missed it at 8.
Right.
And now you missed it. Like it's done. Yep. Too bad. Yep. Really? You're fucking kidding me. If you look at the monthly chart and the max chart on Yamana, the maximum share price topped out, let's say 1st of October 2012 at $20 a share. It's $4.66 right now. It's going to go up 5 times. And that's only if the situation gets as bad as it was in 2012. It's nowhere near as bad as 2012. It's 10, 100 times worse.
Yeah, exactly. So, I think we definitely covered the big issues facing us and how to protect your wealth and even get huge returns, right, in the event of this scenario playing out. So do you have anything else you wanted to add to this picture?
Sure. I'm looking at bond yields right now, and the 30 years over 2.5%.
Yeah, I noticed that as we've been speaking on, well, it's, 1 a.m. on 3/18, bond yields have spiked even higher. So that's interesting, right? Because the FOMC meeting, they had this meeting, they said, all right, we're going to not raise interest rates until 2023. Great. Everything popped except bonds crash. And like we talked about, the US government can't handle that type of move, right, in bonds.
Nope. Well, neither can the mortgage rate market because the 30-year fixed rate is based on the 30-year treasury. And the 30-year treasury just went up 0.1%. So everything I've been talking about with the mortgage market, those guys just got screwed more. In, what is it? 3 hours? It's like I said, there's 2 options here. Either the bond market dies or the currency dies, and they chose not to implement yield curve control. So we have our answer. The dollar's going to spike, but the bonds are going to die.
Exactly. So do you think the Fed's going to come out with an emergency meeting, potentially?
At some point, they will. It's now, the market's just now looking for the maximum amount of pain. When does Jerome Powell says it's enough?
Well, I do think that the stock market's going to have to crash in response to this to really wake them up to come out with an announcement, right? So that could be another great buying opportunity for mining stocks.
Oh, that'll be fun to see because, funnily enough, the Nasdaq is down, but the S&P futures. No, the S&P is down, but the Dow is up futures. Weird. So, no, tech is screwed because tech relies on junk debt. Tesla is filled with it. Tesla and ARK correlate highly with both LQD and HYG at times. So if you overlay those three charts, LQD, HYG, and let's say ARK, you can see a clear correlation. So as long as the bonds are going down, they are screwed.
Yeah, I did want to ask you, so in a hyperinflationary environment, what happens to a company like Microsoft that has a great product, Windows, that everyone uses and needs and buys? Will that hold its value or not?
Hell no.
Yeah.
Hell no, it's going to go down. Microsoft is overvalued. It's not that Microsoft is worth nothing. Sure, they're worth something. Sure, they're going to retain some value. But the problem is that they are currently overvalued. So I would not buy them currently, but I would definitely buy Microsoft. If the market crashes in a March 2020 crash today, then I would buy Microsoft probably in 2 months or maybe a month and a half. If it starts sliding and they can't do anything about it, it'll take a while. It might even take. I can't say. Hyperinflation messes up everything. If the prices start going north because of hyperinflation, that does not mean that they retain their value. That's why hyperinflation is so bad, because you just can't tell price anymore. But you still have other metrics. Currently, the PE ratio for Microsoft, forward PE ratio, is 32.25. Now, we know that on average, a healthy PE ratio is about 15. Undervalued is about 8. Overvalued is 30. So Microsoft is, let's just say, historically overvalued in terms of overvalue levels. And I would definitely not buy them at these prices. Now, compensated for inflation, of course. When the PE drops to like 7 or 8, when it's again overvalued, I will buy it. I will gladly buy Microsoft. Not really for the dividend, but definitely for the growth, which seems weird to see Microsoft as a growth stock. But they're a very large company with a lot of revenue. They can always sell some parts of the company. Focus on core assets, reduce overhead. They are not out of options. As far as I know, Microsoft does not rely on junk debt, even though they have it, but they don't rely on it. So they can focus on a strategy of not expanding, but paying off the debt and consolidating.
Yeah.
Tesla can't consolidate yet. Since we talked about Yamana, the Yamana dividend rate is the forward dividend rate is currently 2.3%, but the forward PE rating is 8. Or no. Well, it changes from day to day, but currently, live stats, the forward PE rating is 9.81. So as I said, it's normal for stuff to be around 15. It's overvalued if it's 30, and it's undervalued if it's about 8. Well, Yamana was lower at 8 when I found it, and now that it's gone up to 4.66 instead of $4 a share, PE has gone up to 9.81. So it's still severely overvalued. It's 40% below the median in the sector, which is 16. So the entire gold sector right now, even though there's almost no money in it, is considering every other PE ratio is higher, it's undervalued. But that's the kind of thing. Price earnings, it contains price. If price is manipulated, price earnings cannot be properly guessed. So PE ratios PE ratios themselves per company become useless. But if the median sector PE ratio is 215 and you're looking at a company with a PE ratio of 175, it's undervalued.
Yeah, fair enough. So where, Deso, should people go to learn more from you?
Well, You can find me on Twitch. Now, let me just take a few seconds to explain what Twitch is, because I've noticed that there is no finance community on Twitch. Again, I'm trying to build a new thing out of the ground. I can't help myself. So Twitch started as a streaming platform for gamers. And over time, it grew slowly to have more things than just games. It started with a chatting category, IRL, which is basically people just talking to cams or talking to webcams, and it turned out to be very successful. They changed the category to just chatting at some point, but it still remains in the top 5, if not 10, of most viewed categories on Twitch. Well, eventually they started adding more. They started adding art, and when art got really popular, they split it into different art categories. There's now drawing, animation, music, basically anything that you can do with an audience in the art sector. There's now a Twitch category for it. Well, YouTube has the finance community, but I don't want to deal with YouTube. And Twitch just has better opportunities for a career, because if you can live of subscription income, that gives you far more security than ad revenue. And Google is a horrible company. I know Amazon isn't much better in some ways, but I'm at least counting on pragmatism. And as far as Twitch goes, it's kind of its own thing. Because it's not grown that large yet. It's mostly still costing money. But at least there's ways to talk to people directly. Rather than having a video culture, Twitch has a streaming culture. So if you go to twitch.tv/Deso Games, you can already watch my previous streams that I did. There is a video section. But if you go there during the times when I'm live, you can talk to me live. I'm just sitting there with a browser answering questions. So if you like this sort of interview and you want to be the interviewee and you just want to ask me a question about something you want to know, just come to my Twitch. On Saturdays, I will have subscriber chat enabled. That means you have to subscribe to my channel to be able to ask me a question, because that's simply my business model now. If you want to reach me and be sure that you can reach me with a smaller crowd, you got to pay. But it's only $5 a month. So it's not exactly excessive. And it's basically a live newsletter. Instead of you just get questions. Like I was talking about Yamana today and going through the statistics. If you have a company or a stock that you would like me with my knowledge to look for or look at and give you my opinion on it, it's not financial advice, but it's definitely my opinion of what I can find out in like 5, 10, 20, 30 minutes. If the stock's interesting, I want to know more about it myself. So I do research on camera. You don't see me. I just record my desktop and I go through the research with you looking at it. And I just give my opinion. I believe it will be more the future of finance than pre-programmed videos right now, because of the trust element that we talked so much about tonight. There's not going to be trust in this in a central system, but there's not going to be trust among people either. Robbery and fraud is going to be much more rife after the economic collapse than before, simply because people will do anything to survive. So how do you know that you're talking to someone who actually knows what he's talking about and isn't reading off a script? Well, you just talk to him on stream. You literally just ask a question. You see the browser flip to the subject you were asking about, and there you go. It's basically trustworthy. And if the guy doesn't know what he's talking about, then you can just keep watching him for like 3 or 4 hours. And if someone can just bullshit himself through random ass questions for 3 or 4 hours, well, then I would start following them myself to find out how to learn about bullshit, because that's pretty good. If you want the live action research and events that are going on, you can find me on Twitter at Deso Games. I I have a website as well, desogames.com, where you can find a lot of interesting articles about economics. And in the future, finance, games, inventions, music, just, my home. And those are basically the 3 avenues of content that I'm producing right now. I also have a Discord where, I have a group of people, and you can find that via my Twitch. And there's a contact form on desogames.com where everything's listed. So if you're in doubt, just go to the website and go to contact. And finally, in the near future, months away, but I am working very diligently on it, I am hoping to publish my first books. I am working on 3 books, translating all my knowledge on finance and economics into hopefully laying the foundations for economics in the 21st century and beyond. So I can talk about the title, not much about what's in it because it's highly work in progress at the moment, but I can talk about the titles. First one is going to be called The Definition of Money. Second one's going to be called The Definition of Value. The third one's going to be called Ethereal Value and the Crypto Future. What that exactly is, you're going to have to wait until the big reveal. But I'm very far in the first draft of the first book. And what I can basically say is it goes through the entire history of money, what it is, what it does, how it works mechanically. And it's not per se a book for economists. It's a book for everyone, or the 3 books will be for everyone. It starts off simple. It goes through the simple history that everyone can understand. It gets progressively more complex. And even if you can't make it through the entirety of every book, that doesn't matter. Just reading the first, say, chapter or 2-3 chapters is going to give you so much information about what money is and what value is, and where the society is going to go in terms of payment intermediaries. That basically it's designed to solve a problem, which is a big problem right now. It's just nobody understands money. Nobody understands value. Not like I do. And it's clear because I can't keep calling bottoms. I called the gold bottom 3 times now. The first one was exact to the day. The second one was exact to the day. And the third one was actually a week before, exact to the day when the gold miners bottomed. So apparently I understand things that other people don't. And I'm going to put all that knowledge into a series of books now. And hopefully it'll become good enough to form the basis of economics in the future.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.